Well, hi, it's Chris here from Capital Counts, and welcome to our first interview for 2024. And what better way to start than to be interviewing David Bassanese, Chief Economist from BetaShares, talking about all things economic. Again, BetaShares has been a long-time supporter of us in running these interviews. So, David.
Great to be with you, Chris.
Good to see you again and appreciate it.
No worries.
There's been a bit of a disconnect, I think, just with markets have been so buoyant. We've had great returns for our clients. But geopolitics, inflation, interest rates, everything else is a lot of noise. But what do you sort of put all that down to?
Look, I think the news, heading into this year, it's pretty good. I mean, the big story, I think, over the last 6 months, 3 to 6 months and heading into this year is the fear of recession to deal with high inflation is dissipating. Economic growth in Australia and globally is holding up better than generally expected. But it hasn't come at the cost of inflation staying too high. Inflation is still too high, but it's coming down. And as a result, we're seeing central banks around the world moving toward at least a neutral bias. So I talk about no longer needing to raise rates. And in fact, starting to talk about, at least in the United States, cutting interest rates. So that's a very good backdrop for equity markets. Now, markets can get ahead of themselves a little bit. I think we saw a bit of volatility at the start of the year with the US market starting to price in US rate cuts maybe earlier than the Fed was ready to do it, as early as March. And so there's a bit of volatility where the Fed pushed back against that expectation. Bond yields sold off a bit, equity sold off. But, in the main, that's noise around what is a pretty good story developing, I think.
The recession that we're all talking about is soft landing, hard landing, no landing that you and I discussed this time last year. Yeah. I think you're now more indicating perhaps a soft landing. And is that applicable for us and the US?
Yeah, look, and when I say soft landing, what matters is inflation. So we could actually have an economy that remains strong, like no landing, like economic growth remaining strong, unemployment staying low. But if inflation still comes down, that's great news. All we care about is that inflation goes back down to the sort of levels we had prior to the pandemic. So at the moment in the United States, economic growth, there is no landing. Growth is still strong. Unemployment is still low. But inflation, at least on the latest readings, has been coming down. So it's actually a pretty good backdrop. And I think, at the moment, even in Australia, consumer spending is weak, but business investment is solid. Immigration overall has bounced back, so it's helping underpin economic activity. So even our economy, again, unemployment is still low, under 4%. So our economy is holding in, and we could be nearing the bottom even of the growth slowdown that we've been through. And sorry, just one final point. Low inflation in and of itself is a positive for economic growth. So that's falling inflation boosts real incomes, and it boosts economic confidence. So we can have a combination of inflation coming down and economic activity potentially holding up.
Just with markets, I mentioned it just at the start, but we've basically had 18 months of nice positive returns. I heard you give a presentation this morning. So are valuations high, stretched, and if I've got $1 today, I'm a little bit nervous because I think markets are high. What are your comments about that?
Look, I think if you look at equity valuations, globally, the market's trading at about 16.5 times forward earnings. In Australia, it's a little bit maybe closer to 16. That's broadly fair value, I think, at the moment. I'd characterise equity markets as neither really expensive or really cheap. They're kind of in a mid-range. In a backdrop where bond yields are around about 4%, 10-year bond yields, and are likely to come down to 3%. So I can't see a big negative hit on a valuation front simply because they're too high. Now, where there is a bit of a valuation question mark is in the large cap technology companies, Googles, the Amazons, the Facebooks, the Magnificent Seven, as it's been called in the United States. Their valuations are stretched from an historical point of view, and that's making the US market look expensive relative to everything else. But again, their businesses are so strong that even that valuation potentially is a structural shift, toward those. I don't see a catalyst for a major, sell-off in those companies simply because they look expensive.
Right. Dollar. It's currently trading around 65 cents. I think you've got a firmer view?
I'm
of
bullish
where it
on the dollar now, and it's because I think the US basically raised rates more than anyone else over the last few years, and as a result, they're going to cut rates more. So that's going to support the Aussie dollar. The relative interest rate differential will widen in our favour. And also, the US dollar is generally a safe haven type of an asset, and so as risk sentiment is improving, I think the US dollar will weaken, and as a result, the Aussie will strengthen. So I've actually got I think it can get to 75 cents actually by the end of this year. And if there's any positivity around China, like there's actually, very pessimistic, I think overly pessimistic expectations around China at the moment because their economy is still ticking over. There's various problems in the property sector and whatnot. But if they announce a stimulus program or the confidence about the Chinese economy improves, that will add even more uplift to the Aussie.
And just geopolitics, what risks do you see, and what maybe keeps you up at night?
We've obviously the geopolitical risks have been the Russia invasion of Ukraine, the fear that would escalate, the fear that the supply of Russian oil on markets would be curtailed, which would jack up oil prices. That really hasn't panned out. That conflict, as terrible as it is still contained within Ukraine. Russia, as much as we want to inflict pain on them, or penalise them for what they're doing, they've been able to export their oil, so that source of restriction is not there. Similarly, in the Middle East, the big concern there had been that Iran would get dragged into the conflict and there might be disruptions to Iranian oil supply. Again, that hasn't happened yet. There's obviously been the Red Sea issue. There's been the Houthis, I think they're called, they've been trying to disrupt trade, but that's adding to some costs of transport for the 1/5 of trade that goes through the Middle East section of the world there. But in the main, that's still a fairly small issue. Geopolitical risks, we talk about them and we've definitely got to keep looking at them, but so far at least they're pretty contained. The other big risk on the horizon is, Donald Trump potentially coming back as president. My couple of points there is that markets these days, whether you like him or not, financial markets are comfortable with him because, ultimately he's for low regulation, low taxation, and that's sort of what markets like. So obviously, he's a bit of polarising figure. Won't wade into that debate, but from a financial market point of view, I think he's a known quantity in the way that he wasn't back in 2016. So whether he wins or not, I don't think it'll be a big risk for markets.
Okay. And then just beta shares in general, you guys manage over 35 billion. You've got over 1 million investors, 90 some products. I mean, you must see the inflows, outflows, but what sort of themes do you see?
Yes.
Products that you're sort of looking at?
So last year, it was a big year for us. We, had very, big inflows and a lot into fixed income. So I think with the bond yields getting up to, attractive levels, a lot of investors are getting into fixed income, even floating rate, bonds like our coupon ETF, but things like our composite bond index, very popular. But I think this year we're starting to see a gravitation back in toward the equities market. And across a range of things, our NASDAQ ETF, very popular, gives you that exposure to the big, large cap tech companies. But even other areas of the market like India, some of the cyber security, some of those thematics. So there's, I think, broadly what we're seeing is the trend toward use of ETFs by both enlightened financial planners such as yourself and self-managed super funds is growing, and that's a good tailwind for us.
And any final comments? Like you seem quite positive about the year ahead. Any other final insights you'd like to share with our audience?
As an economist, you always sort of worry, at the moment, looks like the economy is holding up very well. Inflation's coming down, and it's almost too good to be true. What's going to upset the apple cart here? So you kind of pinch yourself and say, really, this is like a best case scenario at the moment playing out. And so, I'm just wondering, what are the risks that can upset? We've mentioned some geopolitics and The big lingering risk is if the US inflation story and wages growth in the US, given the still tight labour market, doesn't continue to decline. If inflation remains sticky, then we may go through a bit of a rerun of bond yields going higher, equity markets selling off, and potentially, then eventually getting to that recession we long feared. So that's the one risk that's sort of keeping me up at night.
Oh, all in all, I think we're reasonably optimistic.
Yes.
Dave,
No
again,
worries.
thank you very
No
much
worries.
for your time, as always. For our audience, if you need any more information about beta shares or an update on your own personal financial situation, please give us a call on 1300 882 166, and we'll catch you next time. Thank you.